Hello everyone and welcome to the Cyclical Investors Club. This is the fourth week in January 2021 and this video is going to be about why it's important for investors to understand cyclicality with the stocks that they're considering buying. And if you can understand the basics, even just understanding that can save you a lot of money from buying near the top of a cycle, and it can make you a lot of money potentially buying near the bottom of a cycle. I mostly focus on avoiding buying at the top of a cycle because that's a little easier to do and it can save you a lot of money a lot more quickly. And then with a little bit more skill, you can learn to buy near the bottom of the cycle too. But that's a little bit harder. So I'm going to explain the basics of all this in this video, and I think by the end you should have a much better idea at least what to look out for when you're thinking about buying a more cyclical stock and how to identify a cyclical stock compared to one that's not so cyclical as well. So this should give you some pretty easy tools to use to at least get you kind of right in the right categories, and then when you watch more of my videos you'll understand a little bit more about what I'm talking about, what I'm looking about, how I'm thinking about it. So I have a short disclaimer and then we'll get into the video where I show you some several examples of cyclical versus not cyclical mistakes that can be made and the things that you want to watch out for. Hello everyone and welcome to the Cyclical Investors Club YouTube channel. My name is Corey Kramer and this is a channel where I share my investing process and strategies using examples of stocks that comprise the S&P 500 index. These videos are for educational purposes only and are not personal investing advice. If you would like to receive analysis on stocks that are not part of the S&P 500 index, as well as receive additional in-depth portfolio strategies, consider joining the Cyclical Investors Club premium service. It has produced market-beating ideas and strategies, costs less than $30 per month, and it helps support the investor education and research that I share with the public. With that, let's get into it. Okay, let's start off by looking at a fast graph here of Johnson & Johnson, ticker J&J. And the main thing that I want you to pay attention to here is the dark green shaded area in the graph that runs from basically up from the left to the right over the course of like 20 years. Okay, this is the earnings per share, adjusted earnings per share per year over time here. So what we can see here is every year, almost with a lot of predictability, Johnson & Johnson has grown their earnings per share. Until this year with COVID, where they had just a modest 8% decline in earnings EPS, I think every other year is positive. So basically, this is a stock that is not cyclical. Their earnings do not fluctuate very much from year to year. This is just a steady earning business, basically. Now, in contrast to that, let's take a look at another large cap, Caterpillar. So these stocks are both in the S&P 500. They're both large cap stocks. Let's look at Caterpillar's earnings over the past 20 years. Well, we have big ups here and then big downs. It dropped 61% in 2019. Again, we have a big up and again we have a big down. I mean, if you combine, we have a 30%, almost like two 25% in a row. So they went from $8, earning $8 a share to $3.50 a share over the course of a few years. So that would be like a down cycle. And then we have a big up cycle again. Okay. And then last year we had a big down cycle where they lost 50%. So this is cyclicality. And I would say this is the chart of a good cyclical company, because as you can see, each cycle, the peaks are higher. They earn more here than back in 2000 or 1998. It's not on the chart. But then again, the next cycle they earned more, and the next cycle they earned more at the peaks. And then on the valleys, they fell less. Now the magnitude of the falls were similar, but the actual ending point was $2.18 a share here, $3.42, and then $5. So even their bottoms are getting higher. So this is really a good setup for an investor. that's looking to invest in a cyclical stock. Now, the dangers that people get sucked into. The number one danger is using PE ratios to determine value in a cyclical. So because when a cyclical is at its peak, earnings are quite high. So if we look right before this fall, Caterpillar only traded at a 15 PE. So basically an average long-term market PE at that point in time. This is before interest rates dropped really low. So basically it's trading at average PE, but it's at its peak. So what happened is if you invested there, let's see, mid 2008, and through March 2009, you would have lost almost 80%. Almost 70% of your value in your stock in just a few months. So but it didn't look expensive. But the problem with cyclicals is that their earnings dive. So you have to be careful near the tops of cycles. And if you looked at all these, they would be similar. So at this peak right here, again, only a 15 PE, right? I wrote an article on Seeking Alpha right at this peak right here for Caterpillar. And I basically warned people about the potential downside. And at the time, it traded at a little bit higher PE than it had in the past. But we can see that if an investor kept holding the stock here, and we haven't even had like a true down cycle here, over the course of the next two years, you would have lost almost 25%. So before the stock rallied, predicting the next upcycle, which is what's happened here. So this market rise, this price rise here, is predicting these earnings rises ahead of time, and that's what the market does. So unlike last cycles where they gave you a little time to invest near the bottom, this cycle, at least for Caterpillar, isn't. So there's not much of a buying opportunity here, but you definitely could have missed all this downside. And keep in mind that during this time, the S&P 500, if this was a chart of the S&P 500, it would be like up here. So instead of losing 25%, you would have gained, I don't know, 30, 40% or something like that. So that's the type of thing where understanding cyclicality can save you from investing near the tops of cycles. Now, it's really hard to know exactly where the top of the cycles are, but usually the way I measure it is if you have a high quality company, usually they're making new peaks, new cyclical peaks. So again, these earnings are higher than they were here. So I don't even usually consider, so long as the company's a high quality company, I don't usually worry about the top of a cycle until I see the earnings start to get quite a bit higher than they were during the last cycle. And then you just have to kind of pay attention to what else is going on. What the Federal Reserve is doing plays a role too. When they start tightening and interest rates go up, that's usually a signal that you can be nearing the top of the cycle if they're also making record earnings at the same time. Okay? And that's what was going on here. So we had Fed tapering that had been going on for a couple years, very slowly since about 2015. And it basically kind of got to the point where this price had run up so much ahead of the earnings that we knew because the Fed was raising interest rates, it would eventually tip the cycle in the other direction. Now, I didn't know it was going to happen basically right when I wrote the article. I said it could happen within 3 years. So just like if you look at these, if let's say right here I said, hey, we're making new, or maybe right here, we have a new earnings high. The Fed has stopped quantitative easing or whatever. I don't know if they had quite at this point yet. I think it was a little later. This is probably a good time to just exit the stock, and it would have been because things only got worse from there. But that's harder to do. The main thing is just not to think you're getting a really good deal, and especially that's important when the stock price starts going down. So when I used to write warning articles basically when these stocks would drop like 20% off their highs. So let's say Caterpillar made a high right here and it fell 20% right here. So this is usually when value investors, or even right in here, this area, this is usually when value investors start saying, oh man, the stock has dropped. It only has a 14 PE. But as we can see, the cycle was just peaking at that time. So this is usually when people make the mistake. They don't always make the mistake at the peak, but the problem is the price drops off this peak, and then they think it's a time to buy when there's still all this downward price to go. So it'd be the equivalent of maybe buying right here. Okay, so you're not buying at the peak, but man, it's only a 10 PE. Well, it's a 10 PE, but earnings are going to fall for the next several years, and you're going to lose. Basically, you're going to be flat over this time. For 5 years, you're not going to make any money. When you thought you were getting a great deal, and then people can really, really dig in. I mean, they can keep buying all this time. They can buy down, and eventually, if you have a high quality business, it will come back, but you're wasting all that time where you could be invested in something that's not going down or going sideways for several years. So that's one thing. Now, the bottoms are where you can make money. So this is where the real difference comes. If you just hang on to your money for a little while, you can get better deals at the bottoms. And the PEs don't always look good. So Caterpillar fell really fast. So the PE actually did look good at the very bottom. But look, after the price had risen a little bit, just at the end of 2009, we had a 26 PE, okay, here, going into 2010. So much higher than it was at the peak. But investing here would have been really good. We basically, at this point, knew the momentum had shifted in the stock price, okay? And we knew that the economy was starting to recover a little bit, not very quickly, but slowly. Earnings were probably being predicted to rise a little bit, just like they are rising off this bottom. They were being predicted to rise off that bottom, okay? But the PE was 20, like the highest it had been for years and years. I mean, I don't know how far. Let's just look. When's the last time we had a 20-something PE on the stock? We're in teens, all this right here, which also would have been an excellent time coming out of his session to buy it. So, you could buy here and sell near the peak somewhere, and you would have made 18% per year on Caterpillar. And similarly, you buy it at 20 PE, which doesn't look great for this stock, and you could have sold it up here for 65 or 70. Actually, a 90, that's a 100% gain right there, basically. I didn't even pick the peak. So, and you didn't pick the bottom either. I mean, you don't always have to get just right on the bottom with cyclicals. That's what makes them so great. You just have to not make mistakes, which is what I'm going to get into here next. So, once you learn kind of the basics of this, especially avoiding thinking you're getting a great deal when they're just starting to come off these tops and they're down like 20-25%, well, these stocks can fall 80%. Actually, let's take a look at that. I wasn't planning on that, but let's go to Portfolio Visualizer, and I'll give you an example. This is you can do this for free too. I'm not sponsored by them or anything, but this can be useful for understanding drawdowns. And the drawdowns on here, I think, are monthly when you do them long term, so they don't show the precise drawdown. So what this is the drawdown in price, okay? So I'm focusing on earnings when I'm talking about the cyclicality of things, but this shows you the historical price drawdowns. And in 2009, if you bought at that peak, or near it, you were looking at a 70% drawdown. I actually think this was closer to 80% if I remember correctly, if you're just using daily data. And then it's also had, let's see, the one I warned about didn't come down quite as far, 25%. We also had one in 2016. That was the longer one that I showed you, 40% or 50%. So you can get an idea of what the price drawdowns you're avoiding by buying at the top, okay? So let's look at how we can kind of use this to our advantage. And I'm going to use one that's not quite as cyclical just to kind of explain. I want to show you Apple here. Okay, and what I want to focus on is these product cycles that Apple had after the iPhone came out. So after the iPhone came out in like 2008, they had their initial kind of product boom where people were switching over. It kind of topped out about 2013. Okay. And then we started getting these cycles where they would have to come out with a new iPhone basically to boost sales and bring new people in. And then they'd have a year or two where they didn't have a new product and so forth. So they're basically just iPhone product cycles. And you can see these in Apple where we have an EPS decline of 10% here, an EPS decline of 10% here. This is flat compared to 30 on the year before, so it's similar. And I would also note that Apple started buying back tons of shares at this time. So these earnings per share decline are more like 15 or 20% if you pull out the effect that the share buybacks had. Like this 0% is really probably negative earnings if they didn't buy back tons and tons of shares. Probably not huge, but you can see these relatively small product cycles, but you can see that the price reacted to them. So I actually bought Apple about right here, okay, back in 2013 on that first product cycle dip. And then I bought them again. I didn't quite get the bottom of that one. I think it was toward the end of the year. So I bought right in here, and then I bought right here, okay. So I basically bought each one of these dips. And for the record, I sold right here, and the price is way up here now. But we can see the earnings haven't followed yet. So I think the price is getting, even though I could have held on, I don't think this is justified yet. So time will tell. But yeah, so I don't own Apple anymore. But I mean, I made a ton of money on it. From this purchase to where I sold was a 500% gain. So, and all I was doing was buying these dips, all right, of these small cycles. But the point that I actually want to make here is you have to be, in order for a stock to be cyclical, it has to come back. The earnings have to come back, and preferably you want them the next earnings cycle to be a little higher than the one before. And that's exactly what you see with these waves in Apple. Okay, but let's look at their competitors during this time, right? So let's look at Blackberry. Now, this is all easy to do in hindsight, but if you were a Blackberry owner, you had done really, really well if you bought Blackberry back here, right? Let's say you bought it here and you're up at the peak or near it, you know, you're making 100% per year for several years, all right? So, and then the iPhone comes along basically in this time, and even if you held it through all this, if you bought it down here somewhere and you held through here where earnings are still going up, maybe you didn't sell, you're still earning 45% a year, okay? So the difficulty is, let's say you're an investor and you're watching Blackberry and the price you see fall from $138 per share down in 2012 to $6 per share. So that's like I don't know, a 95% plus decline, all right? And you're thinking, or even in here, you know, anywhere in here, 20 bucks a share, 80% decline or 90% decline. And you're looking and they're earning money. And yeah, they had a rough year, but hey, maybe it's just a cycle and the next year they'll earn more and this will continue and then you get rich, basically. So the difficulty is you have to do some work and figure out, is this a permanent disruption that they're going to not be able to come back from? So now they're earning some money again down here, okay? But they had several years where they lost money. And so this is more of a disruption story. And you can see the same thing with Nokia. Take a look at Nokia. And okay, so we have a similar thing. We have this big, they're doing great, things are awesome. Have a recession. Okay, we expect the stock to fall during a recession. But now right in here, the question is, what do you do? Are you a buyer of the stock here, down at the bottom, or even here, because you think earnings are going to come back? You know, you have to make that judgment. So this isn't really a cyclical stock, because so when I see patterns like this, I see a lower earnings peak, okay, for the next cycle or whatever, than we had up here. And so that is a disruption story. Now maybe they've formed a new kind of thing. since 2015, and they might be investable again. You don't know. You can look and see. But this isn't really a cycle, a dependable cycle that we can depend on because they're being disrupted. So you have to be really careful about that. Okay, now I want to give you a more real-time example and compare it to Caterpillar. I bought this. I'm going to look at Twin Disc. This is a very small cap company. Just because I was having difficulty finding a good example for a stock like this. So, and I've owned this stock in the past and made money on it. I bought it, let's see, right in here in 2016, and then it doubled basically from here to here because I thought we would get another upcycle, and we did, but it wasn't quite as big. But what I want to point out here is, okay, so this is the example of a pretty decent cyclical stock until right about here. At the time, I thought maybe they could come up and make another peak, but I sold after, like 100% gain because I wasn't sure, and it was taking a long time. So these guys make like clutches and things, but their products are used a lot in fracking, so you'll notice a similar pattern to the oil price here. So we had that 2008 oil price spike, and then we had another one a little bit, right in here, 2012, 2013. Things started to turn around in 2014, 2015, and this directly reflects that, okay? But what I want to point out here is we have a series now, a pretty clear series of lower peaks. So these are about the same, maybe slightly higher. This one's lower, and then we have another dive, and then we have earnings coming back, but they're a little bit lower, and now they're negative again. So the price here is tempting, and the price has started to turn. But for me, this is one of those borderline cyclical investments that I would stay away from, even though there's probably opportunity here if you're willing to take some risks. Now, the downside risk is just too great for me because they still aren't earning any money yet, and the trajectory has been down. So this is a cyclical where you can make money. You could have made a ton of money in the past. If you invested just not even on the bottom, just down here and sold up here somewhere, 136 per year. All right. So these are the ones that are the tricky ones. And if you looked at something like the opposite of this, which would be like a Micron. So this one I would say is in secular decline because fracking is probably in decline. If you look at semiconductors, they are highly cyclical. So, but you see the pattern going in the opposite direction. Okay, so semiconductors are very cyclical. This is a little deceptive, but we can see just because the scale of it's so big. Now, unlike Twin Disc, which was kind of in a secular decline, yet still cyclical, Micron is the opposite, where it's in an uptrend, but still very cyclical. So if I shorten this, and we can see that where they made money, lost money, made money, lost money, but since here, we have these big cycles, and this is a little deceptive, like I said, but so if you bought at the peak there and held down to the trough, you're looking at a 60% decline. These are actually even bigger sometimes. So, and this is just kind of mid-cycle. We aren't even talking recession here. But the overall trend is higher, and this will probably be higher. So you can make money on this, and I would say this is a better place to try to place your cyclical bets in something like a Micron or something like a Caterpillar than something like a Twin Disc or something that's potentially being permanently disrupted. So those are the things that you want to check really closely on. I'm not going to get into all that in this video. I'm just pointing out some of the bigger patterns and the opportunities that arise. And as you can see, just from the places that I've been clicking on here, we're talking huge potential drawdowns if you buy in the wrong place, and really big upside. And I would say upside in quality companies that are earning money. I know there's a lot of speculative bets being placed out there, and there's a lot of Robinhood type investors who have made a lot of money this year, but these are these are companies that you can count on to basically make money over the long term. So if you fell asleep for 5 or 6 years, your stock price is going to be higher. There's not a lot of doubt in if you can pick a business that's consistently earning money like Micron is. Okay? So I think that's going to wrap it up for this video. And in the rest of the videos that I have out coming this week, we're going to look at 3 different cyclical stocks. One of them I would consider a buy, one of them an avoid, and one of them a sell. I'm going to put separate videos out on those this week, and then I'll get into the individual ones. And if you want to learn more kind of about my thinking behind it, we'll get into it in those individual videos. So thanks for watching. Click the subscribe button if you found this useful. I'm going to keep putting out kind of general videos like this, and then also specific ones about specific stocks as well. And if you have a comment, drop it in the comment section. And we'll see you in the next video. Later.